A crucial question for any business is how long it takes between getting the cash in from customers from the provision of its services or the sale of its products and paying for the costs of providing those services or products. This concept is known as the cash conversion cycle or the operating cycle, and it's a really crucial concept for every business. So in the case of a retailer, we need to look at how long its inventory is staying on its shelves for and in its warehouses for. Because the longer that things stay here, the more value there is that's tied up in the business, and essentially the more funding it's going to require, because as we know, blue assets kind of have to be matched by red liabilities and equity. So if a business is trying to work out how long its inventory is sitting there for, it can do this by equivalently asking itself, if it were to stop ordering inventory all of a sudden, then how long would it take to run out? So let's do this. So if we note that the inventory balance is currently £1 million exactly, we're on day 60, let's stop ordering inventory and see how long it takes to run out. We're selling it at £50,000 worth per day, so it's £1 million and we're selling £50,000 per day. We're up to day 70 now. The inventory balance is steadily decreasing. And we see that we run out on day 80, so exactly 20 days later. And the maths here is relatively simple. Essentially, the answer is, well, it's the initial balance, so in our case that was £1 million, and you've got to divide by the rate at which you're selling that inventory, so the cost of sales per day, so that was £50,000. So 1 million divided by £50,000 gives us the 20 days that we had before we ran out. So essentially this business was operating at a level of inventory of about 20 days worth of inventory. So it was taking 20 days to sell its inventory on average.